Hello, everyone. This is Sebastian McMahon from IA Financial Group, and I'm here with another weekly economic review, this time for the week ending August 13, 2021. Maybe just a word first. We will be on holiday next week for the last time this summer. So don't expect another review next week. But after that, we will be back all the way to Christmas to cover the economy and financial markets weekly. So I'll start with a look at this week's markets at the close on Thursday. So again, negative returns on bonds, mostly positive on equities as interest rates are continuing their rebound from the recent lows. The long index in Canada down 1.74% on the week and minus 6.68% on the year. So we are seeing a bounce in interest rates. Is the bottom in? That's always the question everyone is wondering. But we do know that the recent economic data from the US, from the labor market, which I'll be discussing in a few minutes, have been pushing interest rates higher over the last 2 weeks. So we'll see where we stand and how long it can last. In equities, North America, neck and neck for the TSX and S&P 500 for the week, 0.77% both after 4 days. Year to date, pretty much the same, to close to 20%. When you bring everything back into Canadian dollars, because the CAD was appreciating, has appreciated so far this year, small advantage to the TSX, but not too large. Nasdaq under pressure this week. EFI still climbing back into the top echelon here, 16% year to date. Emerging markets are more volatile, but they still offer lots of value in our books. So we'll see where we end up, but we have a favorable long-term view in emerging markets. Tactical, we're not there yet, but we're getting closer. Oil, no move on the week. The US dollar was strong against everyone this week. So Canadian dollar down, euro down, and the price of gold down 2.85%. So sadly, we need to talk again about COVID cases and hospitalization. It was fun for a while to only mostly discuss vaccination. Now it's we're back in with the fourth wave. So I have a pointer here. Israel, we're seeing lots and lots of more cases. The UK, we had a spike, we had a pullback. Now we're starting to go back up again. US is here. Canada, we're starting to see more cases this week. In Alberta, we had the most cases in a single day since the month of May. So we're starting to see the Delta variant impact. So more cases. Now the idea is that, well, what we see on the right, and we have been presenting for many weeks now, vaccination is doing its thing. It's keeping people away from hospitals, keeping away, making sure that people are not dying from COVID. So these are the main impacts. But vaccination is not the same everywhere, and the Delta variant is very contagious. So we're getting some risk factors that are starting to emerge again. So let's focus on the US, because this is where we have the biggest risk factor right now. I brought that chart a few weeks ago, but it's so good that I decided to bring it again. Vaccination rates by how the states voted in 2020. So when you're here on the left, that means that the vaccination rate is very low. When you're here, that means that the vaccination rate is very high. As you can see, you have two distinct groups here. On the right, the highly vaccinated states, they're all blue, so all Democrats, and the lower vaccination states are red, meaning the Republican. And remember that Georgia here and Arizona here are typically Republican leaning, but the kind of anti-Trump wave of the last election flipped them to blue, but typically they're red. So you see there's a strong political divide between the two groups here. So that means maybe it's going to be hard to accelerate vaccination effort, because there's some strong convictions based on politics, their views on the vaccine. So, and also this week we learned that Texas, well, the governor came out saying that we'll have to pick and choose who we we help in the hospital. They are asking help from doctors outside of the states, so it's really not going well. And as you can see here, the number of new cases per state. Florida here, so the darker the color, the more cases per 100 people, or 100,000 people you have in the state. So Florida, you have Louisiana, so the southern part of the U.S. here is in a more bitter situation. And a sad statistic I was reading this week was that if Florida and Louisiana were countries, they would be number one and number two in the world, respectively, as those that have the countries that have it worse in the new cases rate there. So it's really not a pretty picture. So now the question is, well, cases, yes, but will this lead to more hospitalization, thus closings of the economy in some regions? On the left, we do see, we have some stats right now showing us that lower hospitalization rate is observed in higher vaccinated regions. So it's starting to be pretty clear. Like the UK, we had a strong wave here, but hospitalization remained pretty low. The US, we're starting to see hospitalizations come up again. And look at here, this is only for the state of Florida, patients in hospital. So we are way beyond where we were at the first wave. So it's getting worse and worse and worse. So the idea is, well, what's the economic impact of that so far? Well, we don't have much of an answer yet, but we do have the high frequency data that we can look at. And one that we like to look at is the open table US seated diners, the change from 2019. It's starting to go down a little bit again, but one could also argue that, well, there's a lot of volatility recently. This is just volatility. So the answer is that we don't have an answer yet, but those are not pretty charts to look at, and we are not taking a step in the right direction. So this remains very much a risk economically and also for the markets. So we still have to bring that up as the biggest macro threat that we can see right now and for the coming months ahead of us. So if we go back now to real economic data, so inflation seems to have moderated in July. If you look at the inflation figures here, those are month over month to remove the year-over-year effects, because last year during the summer it was the bottom of the COVID situation. So prices were down. So year-over-year inflation is pushed artificially higher because of that. But still, month over month, the reopening of the economy means that now you have to rehire people quickly, pay them more, get your supply chain in order. Social distancing in plants means the higher cost, less productivity. So inflation is stronger. But now the market was comforted by this here, seeing that in July, the core inflation was only 0.3% month over month compared to close to 1% in the previous month. So say, well, maybe it has moderated. That's good. But now we see that it's starting to be broader. So inflation that is broader means that there's more components within the inflation index that are pushing higher. So if you look at inflation, there's a basket for healthcare, rent, recreation, restaurants, so all of these components together. And we see that the median component is starting to accelerate inflation-wise, so it's starting to be broader. So what that means is, if we go here, this is not our forecast, this is from Oxford Economics, but what that means is that, well, inflation may have peaked. Core inflation in the US may have peaked in June at close to 4.5%, and it should be going down, but it should stay high for a pretty good while. So probably it's going to be all the way to mid 2022 that inflation will be, yes, transitory, but transitory for a bit longer than we might expect. So this has market implications, of course, and we've discussed that a lot in the past, but this should be putting pressure on inflation rates, on interest rates rather, and everything that goes with it. So that was the situation with the inflation, but the inflation figure had an important impact on the market last week. So I'll be discussing that in a few minutes. But just before last week, we also had the employment report. So we'll always need to look at that, the number one economic indicator. Still advantage Canada, with 92% of the lost jobs having been regained now. In the US, we created close to 1 million jobs in the month, and expect a few more of these months of close to 1 million jobs being added. they're only at 75% of lost jobs regained compared to 92% in Canada, but expect some good gains as we are reopening here, unless something goes wrong with the Delta variant in the COVID situation. But on the right, we see that the participation rate in Canada, we're back to where we were prior to COVID. In the US, it's starting to get back up, so people are starting to come back to the labor market. So this is exactly what we want to see. So now financial markets. I've mentioned here, and I've mentioned a few weeks in the last few weeks too, that we might be at peak economic growth. So we'll still have growth, but it's going to be slowing down. What happens in the market when that's the case? So this chart here, which I found very interesting, it's when the ISM is at 60. So 60 is very elevated. Typically, when you hit that level, that means that you're at peak economic growth and you're starting to slow down after that. So you have a few historical points here. You have 1983, 87. So this might look scary, but remember that this was October 1987. So it's another ballpark. So don't be scared by this line here. Maybe focus more on the points that are here, the lines that are up here. December 2003, February and August 2018. So it's not often that the ISM is at 60 or that growth is as strong as it's been recently. But when we reach that level, usually after that we start to taper off. And what that means for the markets is that we have consolidation. It's not the end of the bull market. There's no need to be spooked here. It's just that the mean behavior is the black line here. So you can have some volatility. You can go sideways. You can have some small pullbacks here. You can have bigger pullbacks like we had in 2018, all the way to about 15% drawdown. But you can also have the plus 10%. So right now we're looking favorably compared to this chart. But remember that history tells us that peak economic growth means consolidation. So that's why we are more careful, and being careful here again means being neutral. We're close to, well, we are neutral pretty much on equities. We bought some more bonds to be less underweight bonds, just to protect the portfolio, making sure that we don't take excessive risks. We will be taking excessive risks if we do have a market pullback and we see a buying opportunity. We haven't changed our style at all, but many elements are pushing us, the COVID situation, the seasonality in the market, the peak economic growth, to remain a bit more cautious until we have a bit more clarity, or at least an opening in the markets. And when I was talking about seasonality here, the volatility of the market, so the VIX index for volatility, this is its seasonal component. So what they do is that they take the average value of the VIX over time, and they look at, well, the average for each month, and the months that tend to be more volatile than average and less volatile than average. Now we're entering the period between August and October, where volatility is at its highest. Well, it's slowly climbing all the way to its highest point. So we are just like here in the middle of August. So we are entering this period here. So of course, seasonality, I mean, sometimes some years are much different than others. We don't base our strategy completely on that, but it's an important aspect to keep in mind that typically August, September, October is where you see spikes in volatility. So again, spikes in volatility, if you were already neutral or defensive before that, those are great buying opportunities. And we are not putting more risks in the portfolio unduly when we see the risks that we see right now. So we're more in a wait and see mode, but wait and see mode for equities over bonds. Within equities, we are doing many things here that I wanted to discuss, so that you don't have the impression that, well, it's neutral, everything's neutral, they don't have any views. We do have strong views on many things. For example, the latest employment report, this is this is a bit high frequency data here, but interest rates were very low at 115, and they've started to jump back up from these levels. Employment report was strong, the market starting to expect the Fed to taper its QE efforts. So interest rates are starting to pick up a little bit, and this is helping the financials. So the U.S. banks are starting to pick up quite nicely here. And also when you look at the sectors, sector by sector, the financial sector has already had a correction. From the previous peak all the way to its latest bottom, you had a 15% pullback. So it was already it had a correction, and now it's starting to make sense to add to it. So we did add some financials into our portfolios. We did the same with the U.S. energy sector. We added those sectors because they already had corrected, and if the value trade comes back into focus and interest rates start to pick back up, well, these sectors will benefit a lot. So we added some of that in the portfolios because we want to benefit from the opportunities that are offered to us. Same thing with the TSX versus emerging. No, TSX versus the US and emerging markets versus the US. So both are sending very bullish sectors now. Signals here. This chart here I've shown a few times in the past, but the TSX, its relative valuation to the US. So when it's low, that means that the TSX is very cheap compared to the US, and we're as cheap now as we were at the peak of the dot-com bubble. So we like the value that Canada has to offer here. If the value trade comes back in, Canada should outperform too. So lots of value there. And emerging markets, the same thing. So right now we are neutral equities, a good overweight on Canada, a good underweight in the US. We have some US banks, we have some US energy that are separate themes. We like the TSX. We think we will be outperforming over the next few years by being overweight TSX, underweight or neutral the S&P 500, or at least favoring the TSX versus the S&P 500. Emerging markets were more neutral right now. The technicals and the tactical aspects of the trade are not to our likings yet, but expect us to talk to you a few times in the coming months about emerging markets and how at some point we will be going overweight, and there's a lot of value here to be deployed because emerging markets tend to be quite volatile, and right now we're just waiting it out, but it's a theme that's coming, so expect us to talk a lot more about these. So what to watch next week on the economic calendar? So in Canada, CPI inflation, housing starts and retail sales. In the US, retail sales, industrial production and housing starts. So more very concrete economic data that will tell us more about the state of the North American economy. So the brand new redesign the look for the ia.ca/economy webpage. I always encourage you to go there. Everything that we publish, everything that we write is published there. You can always subscribe to our newsletter if it's not done already. And if you want a PDF copy of this presentation, just write at economics@ia.ca, and it'll be our pleasure to send it to you. So as I mentioned when we started, we'll be on vacation for one last week of the summer next week. And after that, we'll be back all the way to Christmas time with weekly economic reviews. So enjoy the end of the summer, and see you in 2 weeks.